All right, hello everyone. Thanks so much for joining us for this new webinar series from Kinship Conservation Fellows, Cases in Conservation Finance. We're going to go ahead and get started. I think some more people will be joining as we go on, but we'll get started here today. My name is Shelby Riggle and I am the Senior Program Associate at Kinship Foundation. We are excited to have here today Ricardo Bayon from Encourage Capital, and he will be moderating a discussion with Eric Letsinger of Quantified Ventures. Kinship Conservation Fellows is an environmental leadership program of Kinship Foundation. Kinship Conservation Fellows develops communities of leaders focused on collaborative approaches to environmental issues with a focus on market-based principles. The program aims to make the conservation sector more efficient, effective, and collaborative by building the capacity of practitioners through training programs, including our flagship fellowship and regional workshops. The program also supports a global community of fellows and disseminates knowledge on a range of conservation topics. So in this series, which this is our first offering of this, we will talk to different guest speakers each month. We'll learn about what's new in conservation finance, the innovative work happening in the field, how tools are being used to address the finance of conservation outcomes, and what we can learn from the practical experiences on the ground. I also want to give a special thank you and shout out to Ceci Simone, who is a 2014 Kinship Fellow, for helping organize this webinar series with Ricardo and myself. And then just a few logistics before we get started. Everyone is on mute today. This will be a moderated discussion, so we'll have about 30 to 45 minutes with Ricardo interviewing Eric. While that's happening, you should see a questions pane on your view. You can go ahead and type your questions in there anytime during today's session, and we'll get to those questions during the Q&A. When we get there, Ricardo will call out some names and we will unmute participants if they want to share their question. So feel free to type in the questions throughout as they come up. So before we get started, I want to introduce Ricardo, who will be moderating the sessions, these series. So thanks, Ricardo, for being here. Ricardo is a partner and member of the board of directors of Encourage Capital, where he leads the water team and new business and innovation, and also works across several other investment sectors. Ricardo is also a member of the investment committee at the EKO Green Carbon Fund, and prior to co-founding EKO in 2007, Ricardo helped found and served as the managing director of Ecosystem Marketplace. In that capacity, he co-authored a number of publications. And for nearly 2 decades, Ricardo has specialized on issues related to finance, banking, and the environment. Ricardo was born in Bogota, Colombia, and is currently based in San Francisco. Ricardo currently serves on the Kinship Conservation Fellows Advisory Council and also as faculty at the Kinship Conservation Fellowship Program. So Ricardo, I'll pass it to you to introduce Eric and get started. Thank you.
Thank you, Shelby, and welcome everyone. As Shelby said, I'm Ricardo Bayon. I'm a partner and co-founder at Encourage Capital. Encourage is an impact investment firm, and what we're trying to do is find ways to solve big social and environmental problems while also making returns for our investors. And we decided to hold this series of case studies in conservation finance to talk to people who are doing interesting things, innovative things, kind of pushing the envelope on how you bring capital to conservation. And honestly, I could think of nobody better to start with than Eric Letsinger. Eric has a storied history, which he will tell us about. He's the founder and CEO of a group called Quantified Ventures, which is innovating the space of environmental impact bonds, pay for performance structures, things like that. But what I find super interesting is that Eric was also the drummer in a rock and roll band who opened for a number of acts that you and I may know. Who did you open for, Eric?
You got to go there? We're going there already here, Ricardo?
I went there already. Come on. No, anyway, the band opened for a number of big acts. So Eric's used to pushing the envelopes, to thinking different, moving ahead. I wanted him to tell me a little bit about what kind of put him on the map for me was a deal that Quantified Ventures did with DC Water, which is the water utility in Washington, DC. Because it was really one of the first serious environmental impact bonds that was out there. And maybe he can tell us a little bit about how that environmental impact bond came to be, how it worked, and then we can talk about where that's led and what he sees coming into the future in terms of environmental impact bonds and pay for performance. But if you don't know what an environmental impact bond is or pay for performance structure is, don't worry. I think you'll begin to understand it if we discuss this specific deal, this case study in conservation. So Eric, want to tell us a little bit about that DC Water?
Sure. Thanks, Ricardo. This will be fun. So the deal in Washington, D.C., well, let me even back up for a second. How I got into that, I spent a third of my career running agencies at the municipal level in the government, and then a third of my career in the private sector with IBM and PricewaterhouseCoopers, and a third of my career in the nonprofit sector. Got really excited in 2014 when I read about the growth of impact capital, which apparently I live in a cave I'd never heard of prior to the tail end of 2014. And then the social impact bond model, which came from the UK, landed here in the United States. We promptly overcomplicated it to death. But the simple notion was around how can we connect capital directly to the delivery of outcomes, right? Validated and measured outcomes. That got my attention. I've spent my career in performance evaluation and performance management and public-private partnerships, stuff that generally requires each of those three sectors, private, public, nonprofit, to come together and bring what they're really good at and perhaps maybe leave behind what they're not so good at. The impact bond market seemed at the time in 2014 seemed to be riddled with two things: extremely high transaction costs and financial structures that were highly bespoke, meaning, yeah, I gotta sit in a conference room for months on end and negotiate them eating bad sandwiches. So we decided to kind of jump into the space of impact bonds at Quantified Ventures with a maniacal focus on addressing those two things, meaning, can we do these transactions in a non-embarrassing transaction cost kind of way? And number two, can we create things that are highly replicable by working backwards from the capital and aiming towards that capital as opposed to everything being a new snowflake from the financial structure perspective. So in the DC water deal,
Eric, was that what you're trying to do is pay for an outcome. Let's say, I mean, the original ones, let's say they wanted less people coming back to jail, less recidivism. So you would measure recidivism and you would pay for that outcome rather than, you know, paying for programs that you don't know if they're achieving the outcome or not, but you think they might be, right? That's kind of
precisely. And there could be 1,000 reasons why one would need to use outcomes-based financing. So, for example, in that instance, maybe the government is not convinced that that program will yield the recidivism reduction that they want, right? So the risk of that program is a little beyond their reach as stewards of public funds. So they're going to maybe stick with what they're doing as opposed to take a flyer on the thing that looks like it might work, right? And by enabling the government to pay not on the front end by funding a program and hoping for the best, but moving towards paying on the back end once outcomes are actually delivered and validated, pricing that outcome so the government can buy those outcomes. That's the spirit of the whole pay for success, social impact bond, environmental impact bond arena that we mess around in.
So
DC Water, what's that, Ricardo?
No, I was just going to go over there. Tell us DC Water. How did it begin?
DC Water. So DC Water was interesting. It was they found themselves in that classic situation that we look for, meaning they were under a consent decree to fix their sewer challenges, which were immense, and they had capitalized.
There's a lot of people that don't come from the U.S. probably that don't know what a consent decree is, but basically it's the U.S. federal government saying you, a city, are not meeting the clean water standards. If you don't do something about it, we're going to fine you huge amounts of money. So you have a ton of pressure to do something about it. All right, go ahead.
Yeah, and so DC found itself exactly in that position. And they found themselves with two choices. Classic quandary, right? So they could solve that problem with $1 billion gray infrastructure solution, a big cistern. I won't bore you with what that is. No one would ever see it. We'd tear up all the streets. We'd put it in. No one would know it was there. Magic, problem gone away. And that would work. And then they were also flirting with an alternative, more nature-based solutions of green infrastructure. Can we, instead of doing that $1 billion gray infrastructure tunnel to solve that particular problem, can we essentially implement a lot of nature, right? And so you've got the risk profile of gray infrastructure. Our governments are good at building gray infrastructure solutions. Matter of fact, DC Water had just built one of those tunnels. They built it on time and on budget, which is worth a moment of silence of wonderfulness. That's a large public works project on time and on, so they're good at them, right? And they're good at them and they know it'll work. But they were also attracted to the positive externalities associated with green infrastructure, that solution, that innovative solution. Because the health benefits are off the chain, and the environmental benefits and the workforce development benefits. The problem is nobody's ever implemented that much green infrastructure to solve that much particular problem at that scale. And it's not a solution where you can just take the results of how they did it in Portland, Oregon, and translate that performance reliably to Washington, D.C. Because green infrastructure performance is driven by the climate and the gradation and the 4,000 other variables that drives performance of green infrastructure. Okay, so there was the government in the quandary. Should I go business as usual for $1 billion, or should I do $350 million worth of green infrastructure? Let's call that innovation. Let's call this business as usual. So the spirit of what we did was we basically said, why don't we bring in impact investors like you, Ricardo, to essentially pay for the green infrastructure. You and your investors, you want to see these kind of health outcomes, environmental outcomes, workforce development outcomes. You're drawn by that impact. Let's quantify all that. Let's price those outcomes so that the government can buy those and have investors essentially pay for it, take some of the performance risk of the green infrastructure off of the city's shoulders, put it on their own shoulders, so what it comes down to is the investors are betting on the performance of the green infrastructure to achieve the outcomes and deliver the outcomes that humans think will happen. These investors are putting their money where their mouth is, and then when those outcomes are delivered, the government pays back those investors on a per outcome basis against the agreed upon schedule. That was the spirit of DC Water.
So how did it start? Did you go to DC Water and say, hey, do this, or did they come to you, or was it a kind of serendipitous thing? What
100% serendipitous. I met the CFO at a cocktail function, and I was bored, and he seemed bored, and so we sat on a couch, and I had never met anybody who worked at a water authority, and I'm not very interesting, but I'm really interested, and so I had a lot of questions, and 3 hours later, we drew this little thing up on the napkin about how to solve that particular challenge. And got a call from in the morning, asked me to come into the office, and we got to work.
Awesome.
Very little of my life happens on purpose.
Isn't it wonderful how that sort of serendipity leads to such cool things? All right, tell us a little bit more about the actual structure of the deal. Where did you end up in terms of how do you get impact investors to pay up front, to front the money, to do the work, and how do you get DC Water to pay back based on outcomes?
Sure, yeah. So remember from the beginning, we wanted to make sure social impact bonds are called social impact bonds. They are not bonds. So we wanted to, because municipalities pay for most things out of bond proceeds, that's a generalization, but that is a $4 trillion market that's very efficient, the municipal bond market. So we wanted to actually do, instead of inventing something brand new, which the capital markets do not like, and terrifying them, we wanted to actually just work backwards from the municipal bond and say, how can we take this structure that exists and attach our weird stuff to it? Because if we can attach the weird stuff to it and send it through the funnel that normal municipal bonds go through without anybody freaking out and panicking, we might be onto something in terms of scale. And so that was the thinking on how can we create outcomes-based elements to a standard municipal bond. So that was sort of step number one. Step number two was
people who are not steeped in the financial world. A bond is basically a loan that is spread out amongst many people. So a company wants to borrow money. What they do is they say, let's issue a bond where people give us money and we give them back their money plus interest after a certain amount of time at a certain interest rate. And so rather than going out and borrowing from one person $100 million, you go and you borrow $100 from a million people and pay them back in that bond fashion. So sorry, continue.
No, I'm glad you said that. So in the example that Ricardo just gave, if I'm the government and I floated the bond and there were 100 people who did whatever your math was, and let's say Ricardo bought my bond, my relationship with Ricardo, I now have Ricardo's money. I'm going to go do the thing, and I'm allowed to change my mind, meaning I might want to take Ricardo's cash and just burn it in the dumpster out back. I'm not saying I would do that, but I'm allowed to do that because, and by the way, Ricardo won't be mad at me. Ricardo, I have to pay him back his money regardless of whether I spent that money well or not, whether I spent it on the actual thing that I said I was going to spend it on. And here's the clincher, I have to repay him regardless of whether the thing that I did actually worked or not. Does that make sense? So we wanted to change that dynamic so that when Ricardo buys the bond, the environmental impact bond, as opposed to a standard municipal bond, his payback mechanism and the interest rate that he ultimately enjoys or doesn't enjoy is directly tied to whether the thing worked or not. Because now we got skin in the game. Now we got a different relationship. Now we're aligned. So that was the spirit of what we were trying to achieve. And then step one was quantifying the predicted performance of the green infrastructure. So if we put this green infrastructure right there, how well will it perform in terms of generating?
Just to interrupt there in terms of green infrastructure, what we're talking about is saying the problem DC had was when you had a big storm, all that water ended up in the sewage system. Sewage treatment had too much water, couldn't filter it before it put it into the river. So it just sent, raw sewage into the river. So, two ways of dealing with that, as you mentioned. One is to create a big holding tank where you hold all that water and then process it slowly over time. The other way, the more natural way, the green infrastructure way, is to sort of plant trees and bioswales and slow the flow of that water into the sewage system so that the trees take it up and it doesn't go into the sewage system. That's kind of what we're talking about when we say green infrastructure, right?
Yeah, just a big sponge, big sponge. So that was so then we had to quantify the predicted performance of green infrastructure, and that was just nerdy fun. And then great engineering team at DC Water were able to get the predicted performance into some Monte Carlo simulation, again, Nerdsville stuff with some confidence intervals and a normal curve. And we're like, that's how we think it's going to perform. And meaning if somebody can come up with the $350 million to do that green infrastructure, we think it's going to perform like that. And if you can vision the normal curve with the confidence intervals, you've got the middle area. That's where we think it's going to land in terms of the performance. We think it's going to perform in that area of the normal curve. And that tail over there.
You mean it would absorb a certain amount of water, therefore ensure that that when it rains too much, that water gets absorbed, doesn't make it into the sewage treatment plant, right?
Correct. We're actually into the Potomac River. Right. So we wanted to reduce the amount of raw stormwater that was making its way into the Potomac River. At the end of the day, we wanted a cleaner Potomac River. That's the outcome. And it turns out there was enough science that if you control the flow in the sewer, which is a technical engineering term, it's like a sentence, then you'll end up with a cleaner Potomac River. So you have a proxy for the outcome that we wanted. The outcome is a cleaner Potomac River. The proxy metric was flow in the sewer. Once we figured that out, we're like, that's the metric we're going to measure on, meaning investors are going to bet on flow in the sewer. Because if we control the flow in the sewer, then we have a cleaner Potomac River. If we don't, then we don't. So once we got that metric, we were now in the world of hydraulic modeling. And so once you're in the world, which is water through a pipe, once you're in the world of hydraulic modeling, you can create statistical predictive models about how well they will perform if you do A, B, and C. The A, B, and C was the green infrastructure. Now we have the performance, and we have the three areas in the normal curve. We think it's going to land in this middle area. It might land in the far right tail, because it just might, statistically. It might land in that far left tail, right? And so, but once we had that performance, we were sort of on to step three. Step three was, okay, now how do we create a bond out of this where Ricardo, who's going to buy the bond, where we have a relationship where you got to hang around with me for 5 years to see how it works out, as opposed to how bonds normally work, which is you just buy the bond and there's no relationship, right? And so
yeah, it's a relationship of a straight lender. You money, you got to pay me back money after a certain amount of time. So I'm going to be hanging around anyway because I'm expecting you to pay me back the money. But you're saying now I'm not only hanging around, I'm watching to see how my money performed on the ground.
Correct. You want to know about how's the green infrastructure doing. Does that make sense? So you really care about how well the green infrastructure is going. And they do. Our investors, they care. And so the what we did on the financing side, not to go too deep into it, was just in the spirit of trying to keep it simple, because I think that's where the social impact bonds just got too complicated. And so, and by the way, simple is hard, as Ricardo said. Like, I spent a time in my life as a musician. Like, simple is hard. Simple is really hard. And in this world of outcomes-based financing, what you'll find is these things can become PhD studies if you let them, right? So the trying to move the mind towards how can we make this simpler as opposed to satisfying my intellectual curiosity to endlessly make it perfect. All we did was we just mapped an interest rate to each area of that normal curve. So this is how we think it's going to perform. These are the confidence intervals. So we created an interest rate here an interest rate in that tail, and an interest rate in that tail. And we just said, listen, if it lands in the middle, which we think it will, then that interest rate is 3%. If it lands in the far right tail, which we don't think it will, but it might, nobody's ever built this much green infrastructure to solve this problem. They got smart engineers, but maybe it won't. If it lands in the far right tail, that's 6%, back to the investor. And the far left tail is, it totally didn't work, that's 0%. So back to Ricardo, who just bought this bond, the goofy weird bond, the environmental impact bond. Ricardo's waiting till we end up with, at the end of 5 years, when we open up the magic box and we say, how well did the green infrastructure perform? It will either land in that middle, left, or right tail. And then the mechanics.
Just so we're clear on middle, right, left. So the middle, where they get 3%, that's where you were expecting it to perform. That is, it's doing what we think it will do in terms of managing stormwater. They get 6% if it does better than expected, right? It stops more water than they expected from getting into the Potomac River. Therefore, you know, that's good for DC Water because they're doing more than they thought they were going to do. And the investor is happy because they're getting a higher interest rate. They're getting more interest paid back to them. If it doesn't perform, if it doesn't stop water from sewage from getting into the Potomac, then the investor gets less of an interest rate or zero interest rate, right? So that means that it didn't work. The green infrastructure didn't work, but you know, DC Water's paying less of an interest rate, so they're paying nothing. They're just giving back the money without paying an interest at all. That's kind of the structure, right?
That's correct.
And what's interesting about that is that what you're effectively doing, as you said, is you're transferring the risk of performance, the risk that this green infrastructure will deliver what you want it to deliver. You're transferring that risk from DC Water, which would have normally borrowed money and paid it back at a standard interest rate, to the investor. Now, if it doesn't perform, investor doesn't get any interest on its money, right?
Correct.
Very
and
cool.
that used to just be the city's loss.
Right.
And the bond buyer, the bond holder, would have just gotten paid back regardless.
Right. So it's effectively kind of like a bit of a risk management / insurance mechanism for the city in a different way. So you did this. Tell us two things. How did the investors react? Did they like this structure? Did they have problems with this structure? And can you tell us anything about how it performed?
Yeah. So we first of all, we privately placed that bond. So we released that opportunity, that investment opportunity, to a large set of institutions who normally buy bonds. Frankly, we didn't know what the reaction would be. Either everyone would hate it, be afraid of it, freaked out. I don't know. The response was overwhelming. The response was big interest right away. Ultimately, DC Water, as a trailblazer, innovating off of the municipal bond market, which hasn't had a lot of innovation in it over the last century, they ended up selecting Goldman Sachs and Calvert Impact Capital, because they represented sort of the bookends of the broad investor base who expressed interest in it. Goldman Sachs probably doesn't need a lot of explaining. Calvert Impact Capital, 501c3 impact investors, very mission focused, and yet they both wanted the same bond, and possibly for different reasons. There was the Goldman Sachs crew that was very interested in it for its uncorrelation with the broader market, meaning a bond's value once it's purchased sort of flows up and down in value every nanosecond based on macroeconomic conditions and metrics that nobody controls. So it just heaves up and down in value. This particular bond heaves up and down in value driven by this weird thing, which is flow meters buried in a sewer in Washington, D.C., i.e. not the macroeconomic metrics. So you have a stabilizer that moves counter to the rest of your bond portfolio, which is attractive to those who have large bond portfolios. On the Calvert Impact Capital side, it was the workforce, very much the environmental benefits, but it was the workforce development benefits associated with implementing 350 acres of green infrastructure, where you're employing a lot of people to do the ongoing operation and maintenance of that asset that's above ground in a way that you don't have to do when you're building an underground cistern. So it was the workforce development benefits that really attracted that particular impact investor.
Right. So, I mean, it's very cool from a conservation finance perspective, because it's a way of borrowing money, and obviously that's easier said than done for people who are trying to do conservation, right? It works in a municipal utility because that's how they usually work. They borrow trillions of dollars from capital markets, so they're they understand bonds very well, right? And one thing that's important to remember is a bond is a loan. It needs to be paid back in some way, shape, or form. So it's not a grant. This is not philanthropy. So many conservation organizations have heard all this hoopla about green bonds, and they go, oh, I want to do a green bond. And they forget that this is a bond. You got to pay it back. How are you going to pay it back? Are you doing something that will pay it back? In the case of DC Water, it's more straightforward because they pay it back based on the rates they charge water users. So they have money to pay this back. I find it interesting that when you talk about green bonds, conservation organizations forget about the bond bit of the phrase, and sometimes financial players or people in the bond markets forget about the green part of the green bond phrase, and they go, yeah, it's a bond, just like any other. We'll just label it green, and there's no real green benefit. One interesting question that has been posed is, how do you measure whether it gets the 0%, the 6%, or the 3%? What are the sort of measurement structures you set up with DC Water?
For this particular one, the metric was that flow in the sewers, and so we just put flow meters in the sewers, and we left them there for a year at the right area where the gradation of the earth is such that the green infrastructure performing would be the sponge thing, control it dumping into that particular sewer. We put the flow meters in there to measure the flow of the sewer. Remember, that's the hydraulic modeling thing. And we used that, and we left them in there for a year to create that baseline. And then normalized that data, calibrated it, and so then we have a baseline. The project itself was a 3-year implementation of the green infrastructure. So there's 1 year of data collection for the baseline, 3 years of implementation of the green infrastructure. It's interesting, you can see it. It's fun to live in this town because it's all over. And there's just a lot of development of green infrastructure, and it's fun to see. And then you get to year 5, which we're about ready to do, and now the green infrastructure is in place. We put the flow meters here in year 5, and we leave them there for a year, and it's collecting the data that answers the question, how's the green infrastructure doing? And once we have that answer, there will be a magic answer, and it's answering the question, where did it land? We predicted it would land in here, did it? And then
yeah, we're going to get into the nerdy stuff of exactly how you measure, how you ensure that the year you did the baseline wasn't a crazy off year, and the year you did the measurement 5 years later wasn't a crazy off year, and that had nothing to do with green infrastructure. I'm sure you could answer that, and I'm sure there's places we can send people to. We'll send you guys the link to the bond so you can see terms and all this other stuff for the bond. I think what's interesting to go into now is, okay, you did one. You started trying to do more of these in different cities. How did that go? What happened? Are all of the water utilities of the U.S. banging on your door wanting to do more of these? If so, why? If not, why not?
Yeah, good question. So, I mean, listen, I like I said, I've spent my career in government. Like we're not fast followers, and we're gonna let somebody else kind of go to the first 20 of those, and we'll see if they lose their eye in the process, right? And if not, maybe I'm not gonna do that. So knowing that, we believe that this environmental impact bond model will be tough sledding in terms of adoption, and we got to get to 20 of these. Once we get to 20, that is, in our theory of change, we see that as the tipping point to become where these things are no longer considered bizarre and dangerous, and where somebody might lose an eye. And so we're let's see here. We moved to do our second one of these in Atlanta. They raised their hand real fast. They were all in. They were a joy to work with. Great leadership there, from the mayor to the head of the Department of Watershed Services, to their staff. They were just amazing, super creative. Wanted to figure out how, but they wanted to do it different. They wanted to do it their way, and it was great. We're like, all right, let's go. And the innovation that we wanted to accomplish was, on that particular environmental impact bond, was, remember I told you the DC water one was privately placed, so we had to sit in a conference room, the bad sandwiches, negotiate. That's not how normal municipal bonds are issued. There's a very efficient way of packaging your thing up and sending it into the world, and suddenly there are buyers. We wanted to do it that way. And so the Atlanta environmental impact bond was the first publicly issued environmental impact. Matter of fact, it was the first publicly issued impact bond of any kind. What does that mean? It means I never met the people who bought it, and that's efficient. And so that was an accomplishment there.
But otherwise, the structure is similar in the sense of, the different interest rates based on water into the sewer. No real change there.
Fairly similar. We ended up having a different metric, which was a little bit farther upstream than the flow in the sewer. So, for example, we're going to nerd out on sewers here for a second, but hang in there with me. It might be worth it. Remember the outcome.
Talk about sewers, right?
The outcome we wanted was a cleaner Potomac.
Rats. Go for it.
The outcome we wanted was the cleaner Potomac River. The logic chain goes something like this. If you implement the green infrastructure, like it's in the ground, you will capture a certain amount of stormwater. Remember, it's just a sponge. If you capture this amount of stormwater, then you will release it at this time rate slowly into the sewer over a 2 or 3 day period of time, so that you don't hit that peak flow that the diameter of the sewer can't handle, right? So you implement the green infrastructure, you capture a certain amount of volume, you release that volume at this rate, which creates the flow in the sewer. That amount of time release, it goes into the sewer, and then and then you end up with a cleaner Potomac River. That is the logic chain. And so in Atlanta, they wanted to have the metric be more of a volume capture, which is just 2 steps up from the flow in the sewer. And this had a lot to do with what their priorities were. In Washington, D.C., remember, D.C. was under the gun with that consent decree to fix their combined sewer outflow challenges. So flow in the sewer is everything. That's the ball game. And Atlanta's priorities were a little different. It would get too weeds if I went further, but
let's skip the weeds. So now you've done one in DC, you've done one in Atlanta. Any other cities?
Yeah, so Baltimore's actually closes in about 10 days. Very exciting. More green infrastructure to address flooding. We're doing the same model in Buffalo, New York, and in New Orleans and Memphis, Tennessee, and Hampton, Virginia. So anyway, all to say, there are 455 cities around the United States with combined sewer challenges, and so those are generally the cities that we are using the environmental impact bond to address that particular issue.
One question that I've seen out there is, in talking to some water utilities about this as an idea, what they push back on is saying, look, we borrow money at the lowest possible rates out there because many of us are state entities, and therefore we can give investors tax deductions, and so our interest rates are super low. I know my green infrastructure works. I don't want to pay more if it works more, or what have you. I know where it is. I can just set a low interest rate, do the work, get it done. I'd rather do that than complicate things on environmental impact bond. Have you come across that kind of a reaction?
Yeah, and I would say then you should do that.
Yeah.
And I would also ask, where is it and why haven't you?
Exactly.
I get the academic pushback. Listen, here's the realities. Our cities and states and counties are paying for a lot of their infrastructure out of nickels and dimes they're able to find in the sofa, right? They are wildly underfunded and they are wildly underfinanced. And if they are, and at the same time, we're asking them to take on these unbelievable challenges associated with climate change, pick a thing, right? It's coming right at them, right? It's not academic to them. It's, I got to get it on the field now. In which case, if we're going to expect them to choose innovation over business as usual, we shouldn't expect them to choose innovation over business as usual unless we give them new ways of paying for it.
Yeah. Okay, cool. I don't want to, I want us to get to the question and answer period relatively soon now, but there is a question there about other examples of the use of this environmental impact bond pay for performance structure. I know you're involved in several, one to do at least with fires, one to do with agriculture. Maybe can you tell us a bit about other uses other than sewers and green infrastructure for these structures of pay for performance?
Yeah, I'll go with your agriculture one. It's a good example, and by the way, it's a good example of, man, this stuff is hard. But if you can get it done, if you can get the first one done, the brand damage these things are replicable. And so it was with that same spirit that we took the environmental impact bond model to see if we could use it to address water quality issues that municipalities are facing who are downstream from big agricultural states. So, for example, here's the puzzle we tried to tackle, all about water quality. Can we pay farmers with investment capital, pay them profitably to implement conservation practices on their farms that would reduce the fertilizer, the phosphates and the phosphorus and the nitrates from getting into the waterways, off of their farm into the waterways and coming downstream to the municipality, who then has to buy in the cartoon version, buy $1 billion machine to process all that nutrient load that's reducing the quality of their water. That's expensive. And the question was, would it be cheaper if I just paid the farmers to do that upstream than it would for you to buy that $1 billion machine? And if so, how about I do that? We'll predict the flow of nitrogen and phosphorus reduction to the downstream municipality, see if we can get it in the normal curve, and then basically ask that city, the downstream municipality, to just buy the reduction outcome instead of dipping into their wallet and paying for a solution on the upfront. That was the spirit of how we started. The answer was no, wildly no, like not even close. And that was a painful day. And we have a lot of painful days here at Quantified Ventures where because this stuff, this stuff takes a while to run at. And it's freakonomics type stuff, right? And so when that didn't pencil out, that was not a fun day here at Quantified Ventures. But our methodology is very hypothesis driven and 2 steps forward, 1 step back. That was like 9 steps back, right? And so, but what we figured out was those things that we are paying farmers to do also sequester carbon. So why aren't we pricing the sequestration of carbon and selling and stacking that outcome on top of the water quality benefits that we're wanting the municipality to buy? By doing no extra work, we were able to price that carbon and start to sell those outcomes to the Cargills, to the McDonald's, to the Danones, to the, you get it, right? Corporations who have made big sustainability promises to their shareholders. Many of them want to be buying carbon offsets from players within their
supply chain.
Their supply chain, right? And so, meaning a unit of carbon sequestered out of their supply chain is more valuable than a unit of carbon sequestered that's not in their supply chain for obvious reasons, to make their supply chains more resilient. So suddenly we had a buyer in corporates for the carbon, and we had a buyer in municipalities and states for the water quality benefits. That penciled. And when that penciled, we started to run tens of thousands of acres through that model to stress test it, and it kept holding water. And we are now raising the capital to actually scale that across Iowa and 6 other neighboring states. So that's exciting.
How much capital are you looking to raise, and who would be providing the capital, and how would it be spent?
Anyone interested in investing in that thing that we just talked about, I'd be very gladly, I would happily have a conversation with. There's a few different kinds of, there's some debt, there's some equity, and the equity has 2 different pieces. So rather than, yeah.
So it's a much more complicated structure than the straightforward DC water ones, what you're saying.
Correct.
All right.
It's not a one-off transaction.
There's one more example that you guys are working on. I don't know if you can talk about it or not, but having to do with forest fires, right? Can you tell us a little bit about that, or is that not yet cooked?
I would say that's not yet cooked. We've got some really good friends at the Zach and our good friends at the at Blue Forest, who have done some really fantastic work in the world of wildfire mitigation. The spirit that underpins all of our work is pay for success, is outcomes-based financing. We've got a really exciting project that we're working on in southeastern Colorado, because it's an interesting puzzle in the sense that there are multiple beneficiaries, right? And so it's the commons problem, right? So nobody wants to pay for the mitigation of the wildfire because it actually does cost money, but everybody would benefit from it. So who are those beneficiaries? What's the price of that outcome? We're heading into the 3rd and final phase of our work on that particular fund. That's a fund model. And Ricardo, I think talking about the details of that would probably be a little too soon, only because what I have found, these things change, right? You know, we don't do a whole lot of, if I told you what it looks like today, I guarantee you it'll look completely different in 3 weeks from now.
No worries at all, Eric. Let's leave that. I mean, I'm pretty sure we're going to have Zach and his team on one of these webinars in the not too distant future. So I'm on the board of that Blue Forest fire resilience bond. So we're going to talk about that for sure.
Good. We're big fans of their work.
Yeah, they do good work. So let's get into the question and answers, and I'm going to call your name, and you will be unmuted to ask your question, and we'll take it from there. Some of them I think have been answered, so I'm going to try and pick a few that are out there. If you really want to get in there, just retype your question. If I haven't gotten to it, we'll see how far we go. So the first one is have you got any, well, I'll let you ask it. Candace EB. Shelby, could we unmute Candace EB?
Hi, I'm talking from South Africa from the protected area agency, Sand Parks, and I was wondering if you had any examples in water or carbon with a less obvious financial return in the protection of species or the protection of landscapes. I appreciated, Ricardo, your comment on that conservation agencies sometimes forget about the bond part of it. But notwithstanding that, yeah, do you have any thoughts or ideas around possibly, I know there's some thoughts around rhino poaching impact bonds or something like that? Thanks.
Let me take that, Ricardo.
Go for it.
Okay. The short answer is we are only now beginning to layer on species conservation onto some of our existing models. We've not been able to make them when we've run at them directly, which we haven't done many times. We've not been able to make them pencil. But what we're finding is that it's a great revenue stream to layer on top of something that already pencils. So for example, that agriculture play that we are that I just described in the Great Lakes in the United States, which is all about stacking outcomes. The outcomes, we're selling the carbon to corporates, we're selling the water quality benefits to municipalities because that's what they care about. We are now layering on some endangered species benefits to some corporates who actually benefit, who need that benefit. So there are two specific species, one's a bumblebee and one's a specific fish for a specific company who is in the food production space who needs to purchase those credits. So all to say, this is that you're asking a question about in our work is sort of the bleeding edge of where we are. We've not seen models that work directly to just, you know, like the rhino bond was a philanthropic model, and we're eager to work with folks to figure out how to do this, but that is not an area that I would feel remotely comfortable saying, yes, we have figured something out.
And it probably has to do with the revenue streams, which are hard to find. I mean, in water, you have water rates. In national parks, usually it's just government budgets. So maybe there's a way to tap into government budgets more efficiently. But yeah, I haven't seen much other than in water and stormwater in this pay for performance and some of the leading edge stuff that you're doing with agriculture and layering stuff. There was a question about layering co-benefits. Hopefully that answers a little bit of it. Let's call on JP Gibbons had a question. JP?
Hey, Ricardo. Hey, Eric. So JP Gibbons, down in Washington, D.C. I work for Cambridge Associates. So I know a bit about the impact bond structure, Eric, and my question is around getting that match right on the return perspective. I know the first few that were in the United States needed guarantees encourage investors to come to the table. And I'm curious how you came to an agreement between the issuer and the investors on that interest rate. In particular, you talked about the DC water bond, and there was that, I think you said in the middle we decided on 3%, and then at the extremes there was other ranges. Was that based on any underlying cost of capital for DC water, or how did the expected, if they operate, at the median 3% return would be the appropriate return figure?
Yeah, great question. So first of all, there's no like magic bullet answer to your question. It was more of a triangulated response. Number one, we wanted that middle interest rate to be commensurate with as close to their cost of capital through a standard municipal bond as possible. So that's going to put us in that 3% range. And then the other thing I will say in terms of the risk of the green infrastructure and your ability to due diligence it, if that makes sense, is quite different from some of the challenges that social impact bonds face. Meaning, this is about predicting flow through a sewer, right? It's water through a pipe. It's hydraulic modeling, right? And it's statistical modeling, Monte Carlo simulations, right? As opposed to underwriting the risk of a human who is part of this vulnerable population moving through this particular program implemented by this particular organization to achieve this particular social outcome, right? There's just fuzziness in that, in a way that there isn't as much fuzziness as there is in the world of hydraulic modeling, which is one of the reasons that we moved to this space, meaning we believe that, so we have an appetite to avoid all those guarantees and the stacking and the bespoking, can that be a word? We have an appetite towards and a methodology about working in the environmental space by bending towards very specific proxy metrics, and they're not obvious on day one, but they're metrics that are good proxies for the outcomes. Proxies and the other definition that we look for that makes an ideal proxy metric is something that can get into a body of science once you're into like hydraulic modeling. And I know all these stories sound obvious in the end, but when you're staring there at the like, hey, fix this, the answers were not obvious on day one. But the spirit of what I'm saying is, the more exact of a science you can get your metric that you're pricing the outcome of, the farther and farther you're moving away from worlds of bespoke financial structures that include things like guarantors.
Great. Camila Monteiro. Camila.
Hello, thanks. I'm not a financial expert, so I was in doubt when you said that this kind of bond has a value that is more stable than the rest of the bonds portfolios. So this was something that got Goldman Sachs interested in the bond. And I was wondering why is more stable a bond value that changes with the flow in the sewer than a bond that changes with the macroeconomic conditions.
So if for organizations like most of the investment houses up on in Wall Street, they have massive portfolios of bonds, right? So they have hundreds and thousands of bonds in their portfolio. When you have hundreds of thousands of anything, well, all of those things are individually moving in value at the same rate because they're tied to the same three market metrics. And they would rather have a more stable portfolio that didn't go up and down every nanosecond in a way that they can't control. One of the ways of stabilizing that is by buying bonds that move as a result of something else. And in this case, ours happened to be a bond that the value changes by something else. It happens to be the green infrastructure. And so when you put that in your portfolio, it makes your whole portfolio, because it's uncorrelated with the rest of the bonds in your portfolio, it just makes your portfolio more stable. Ricardo, anything you want to add to that in case I botch that?
It's really less about stability and more about diversification. So the broader the things that move something up and down, the better, just because you're going to have every little bit of everything. The problem comes when everything you're diversified is correlated. In other words, one thing happens to the housing market, to interest rates, it moves everything. That's a problem for you in diversification terms. So what you want is something that has no correlation to the standard stuff in Wall Street, which are those macroeconomic indicators, interest rates, housing, all the stuff that we see in the news all the time. And the interesting thing about this bond that Eric's talking about is that it doesn't have that correlation. It's correlated to, sewers and water flows and rain patterns and how this green infrastructure deals with that rain pattern. And so that lack of correlation is super interesting to people on Wall Street. So that's the way I would put it. Okay, let's go to Viviana Luján Gallegos.
Hi, good afternoon. My name is Viviana. I work for Walls Company, a consultancy research firm. I had a question about the co-benefits. You mentioned in the beginning that it was interesting to impact investors because of the co-benefits like workforce and CO2 storage, etc. And you talk about the end how you were stuck in these other products, especially the farmers. But I was wondering if in the water deals you were also measuring and reporting on those.
Yes, good question, by the way. And so, listen, I think this whole world of outcomes-based financing, I think we're just getting started. On that DC water one, we only had one metric, and it was the flow in the sewer that we put all the financing around. But to your question, there were some workforce development benefits, and we did quantify those and agree to report out on them, to measure and report out on them to the investors in the same rigorous manner that we evaluated and measured the water quality. But in the spirit of not going for perfect, we didn't tie the financing directly to the delivery of those jobs. And I think what you're seeing with the agriculture work that I described, where we're starting to have multiple outcomes priced differently and sold to different audiences, you're seeing the maturation of the space, right? And where we intend to keep going towards is stacking multiple outcomes, because there's very few in our language, there's very few interventions like green infrastructure that have only one benefit. And usually that one benefit is shared by multiple parties. So we see this outcomes-based financing model is progressing more towards enabling multiple beneficiaries of one metric to participate in the financing of these interventions, and the quantification and pricing of multiple outcomes also going to multiple buyers. But we'll get there.
Great. Eduardo Luna.
Ricardo, I think Eduardo has left the webinar. But perhaps we can just read his question and answer regardless.
Yeah, the question was, in these schemes, can investors participate in the decision making of how the project is implemented? So did Goldman Sachs have a say in how the green infrastructure is implemented or not?
let's see here. In that particular one, once the money exchanges hands, it's up to DC Water to implement it. They've agreed on how they're going to do it, but Goldman Sachs not allowed to just show up and say, "Hey, I think you're holding the shovel wrong." That's not how that's going to work. That said, we have a lot of investors who do approach Quantified Ventures and say, "These are the outcomes we care about." And then we work backwards to deliver those outcomes to those investors by looking for projects that yield those type of outcomes. Our projects start all over the map, meaning some of our projects start like that. More often than not, it's municipalities calling and saying, "Hey, this is how we currently achieve our outcomes. We're attracted to this innovative way of maybe doing things, but we can't get there. Can you help us get there?" Hopefully that answers some of that question.
I think Andrew Goldberg had a related question about how to manage investors. Andrew, you still there?
I am. I was curious again about how you selected, well, how the DC folks selected those two investors. I get that they were on opposite sides of the spectrum, you know, the white hat and the black hat, but you know, how did the sales pitch work for both of them?
DC Water, once we packaged the investment opportunity, DC Water sent that package to a large set of investors who had expressed interest in that transaction. That created conversations, and ultimately DC Water selected those two investors to proceed to the next step in the process, which is, you know, let's get the bad sandwiches and get in the conference room.
And that was, so the bad sandwiches led to $350 million.
The time spent in the conference room, you know, remember, everybody was doing something for the first time, and so it took real creative partners. It took being open. It took being candor. It took candor. There we go. And it took being persistent. And those were the partners that DC Water selected. They thought they brought those characteristics, and then that we did a lot of work together, one step at a time, to figure out how to make this work for all parties.
Got it. Okay, so it was a very bespoke process to go through all the hoops to issue the bonds with those conditions.
Yeah, I think, you know, most bonds are publicly issued. This was a privately placed bond, and so privately placed bonds are by definition bespoke.
And there was a difference between what you did in Atlanta, which was not privately placed and bespoke, but was rather put into the more generalized market.
Correct.
So Jenny Clover, is that Jenny or is that Christo? I can't tell. There was a previous question. Anyway.
It's Christo. Sorry, it's my my wife that introduced me. Can you hear me, Ricardo?
Yes, go ahead, Christo.
Nice seeing you again. The issue, I know you didn't want to expand on the fire issue, Eric, but we're in the process. I'm also from South Africa. We're in the process of going back to the market with a big integrated wild and fire management program again. And I was wondering whether one could possibly unlock bonds into integrated wildland fire management. You know, 60% of our biomes are fire prone, and having sort of long-term funding to maintain these systems is quite important. And I was wondering whether you have some ideas or how you were going to approach that.
Yeah. Well, listen, I'm sure, by the way, I would love to have a conversation with you. We would love to have a conversation. We have a team working on the wildfire initiative in Colorado. We've learned quite a bit. And the short answer is yes, that's a bond. And so I do think there's, we've run pretty hard at that particular hypothesis of whether we can use if our model can be helpful to address wildfire management. And we're encouraged. All to say, rather than go to the deep end of the pool here, I would love to find a way to connect with you, and to begin that conversation.
And Christo, I think I should also put you in touch with Zach and the folks at Blue Forest who are running a pilot wildfire bond. Again, bond may be a misnomer in some of these cases, but a structure, a financial structure that is interesting to address wildfire in California. And they're running a pilot and they're hoping to scale it across the US. There's a ton you could probably learn from what they're doing. Shoot me an email. I'll put you in touch with them as well. And we, as I said, I'm in the process of wrangling some of them to do one of these case studies in conservation. So you might have one of those specifically on fire in the not too distant future. All right, we've got another 15 minutes by my clock. Let's go to Lizzie Marsters. Lizzie, you there?
Hi, Rick. My question was, some of these outcomes, at least on the DC bond, might be to no failure of the implementation of green infrastructure. Are those catastrophic events calculated into the Monte Carlo simulation?
Yes. Yes. So our catastrophic force majeure stuff's all accounted for. But so is what Ricardo, what you were saying about like what happens if there's just no rain during that year when we're, that's all. And I'd be happy to send the model. So these are all public documents. I'd be happy to send the model and how we did that. There is a very well paved path for calibrating your data to, meaning if it didn't rain or if it rained every single day during that baseline, you'd end up with the same baseline given how we calibrated it. And
yeah,
but I'd be happy to share those documents with you if that's of interest to anyone.
So there was a related question from Daniel. Daniel, rather than having you ask it, I think the answer is we can send you information on the details and the nerdy details about your question about determining a constant factor for drainage area, green infrastructure area, how many acres drainage area does an acre of green infrastructure serve, that sort of thing. There was a lot of work that was done on that, and that was some of the work that Quantified Ventures did. It's easier to show it than to explain it, I think, in words. So happy to send you an email on all of that. So let's turn to Aaron Ferguson. Aaron, do you have a question?
Yeah, hey, Eric and Ricardo. We're trying to establish sort of a stewardship model in Southeast Alaska based on indigenous guardianship. And we're exploring financing it through a variety of means, including philanthropy and redirecting some carbon credit money, as well as thinking about voluntary tourism payments, since we have so many, well, not this year, but we will have so many visitors on cruise ships. But we hadn't really thought about sort of this impact bond or pay for success model. So I'm not sure who you would think, if we tried to implement something like this, would be the payer. Would it be the government or the Forest Service? They own about 97% of the land in the region, so not sure how we would think about that.
Well, the U.S. Forest Service, they're actually one of our biggest clients. They like this model of pay for success, and so they have an appetite to think this way, which is a major step and something to be leveraged. There's another transaction you should maybe look at on our website where we're using this model. Actually, it's actually a project for the U.S. Forest Service. It's in southeastern Ohio, which is investing in one of their trail development. Basically, we're building a world-class mountain biking trail in the Wayne National Forest, and the investment comes from private impact investors like Ricardo, and the payback return comes from the bed taxes of the 6 cities that are adjacent to the national forest. And so think of Appalachian Trail in a circle. Appalachian Trail, not a circle, right? And so you hike it, you stay on it for a day, you get off the trail, you stay in the motel, you stay in the diner, meaning you spend some money, and then you get back on the trail, and then you keep doing the trail. We bent that trail in a circle around the perimeter of that national forest, where the drop-off centers are in those municipalities. Those municipalities have currently, this is Appalachian, Ohio, they have fairly empty motels and fairly empty diners. But if we build it and they come, in theory, their diners will be more full and their motels will be more full. And the payback mechanism to the investor is out of that bed tax for those full beds. It's an interesting transaction and an interesting way to tap into local economic development as a means to get trail development on the field. We're now replicating that across the state of Pennsylvania, but there's some similarities there to what you're describing that you're looking at there in Alaska. Maybe we could start a conversation.
Yeah, and I would just add that that there's probably something you can look at on carbon. So I think the key is to try to understand what are the sources of revenue that are available to you. Carbon is one, timber is one, you know, maybe tourism. I don't know the area you're talking about, but start thinking about like what are those sources of revenue, and then think about different ways to tap into them to achieve the conservation outcome. If you shoot me an email, I can also put you in touch with the people at the Forest Service who are kind of running their innovative finance lab at the Forest Service that are working with Eric and are working with a lot of different people to come up with innovative ideas to address issues of the Forest Service. I'm sure they would love to brainstorm a little with you on what could be done in your neck of the woods, as it were. All right, so Paula Bernasconi. Paula? If we lose Paula.
Hi, I'm Paula from Brazil. Thank you very much, Eric and Ricardo, for that. My question is on the DC water case you mentioned. You said that the DC water payback based on to the investors based on the money they charge to the water users. And my question is that for the citizens, I think that the water users, is there any difference to the amount they pay in taxes depending on the different performances that the system gets? Thank you.
Less taxes,
not
more water rates, right? Yeah.
Was it clear?
Yeah, so yeah, go ahead.
No, I was just going to say that it's not so much taxes as it is water rates, although taxes do come into it. If it's less the utility model where you're paying for water, right? But I think the question stands, and was there any change in the rates that DC Water was charging as a result of the way these bonds are structured?
Not directly, meaning there wasn't a metric that said if the green infrastructure performs like this, then Eric Letsinger, who lives in Washington, D.C., will have a reduction of X to my water bill in February. It wasn't that.
Yeah, I think where it gets indirect is the sense that all utilities look at all their costs, including what they pay to service their bonds, the debt, the interest they pay on debt, to calculate water rates. So the big picture of all of their costs, including their debt service, does affect water rates. But it isn't a direct correlation, right? Okay, so we're going to try and do maybe 2 more questions. One from Babajide Agbula. I'm sorry if I mispronounced your name.
Thank you very much. Nice presentation of that. Now, you said growth is fundamentally a process of investing in various forms by society, and the rate of quality of this growth depends on the amount of funding, right? Now, with this in mind, how do you now raise financing for conservation projects in an economy where there is very little awareness for species conservation? Thank you.
So it sounds like you're coming from Nigeria. So
Yes.
I guess the question, Eric, is, in a place like Nigeria, which has very little money to begin with, how do you invest in conservation? Is there some utility to these types of models in a place like that, where maybe a water utility has a lot less money than DC Water, or doesn't access the bond markets, or anything like that?
Yeah, I think the outcomes-based financing that I've seen outside of the United States has mostly been where, or in areas like where you're from, our philanthropy or the UN has paid, or the World Bank has played that role of the outcome funder, meaning where there is not a government institution who can be that back-end outcome payer. Philanthropy is sometimes willing to play that role, and some of the multinationals who have a vested interest in seeing those outcomes delivered, who are maybe looking for new models to drive funding to a region, might be interested in not just more grants or low interest loans, but also playing the role of a back-end outcome funder. Those are the models that I've seen.
Yeah, so I think you're absolutely right, Eric. So foundations might be one source of capital. World Bank and those multilaterals might be another one. The bilaterals, I would add. So the aid agencies of the UK, of Germany, of the US, and others might also be some of that. I know JP Gibbons, who asked the question earlier, had worked with USAID and was coming up with innovative approaches to have USAID money out there. I think even in places like Nigeria and others, there can be innovation in how different things are delivered if you start measuring performance as opposed to activities. I think this is a model that we're only just now beginning to understand and experiment with, and there can be a ton of innovation in how it's done in different parts of the world. So unfortunately, I think we only have time still for another 2 questions. So let's go with Chaitanya Krishna. Sorry if I'm mispronouncing your name.
Hi, Eric, Ricardo. Thank you for that. So my question was, are you aware of any bonds, to help manage coastal areas, ecosystems? It could be, for example, yeah, go ahead.
Yeah, I think so the short answer is yes, and I think that's an area that we as a company would like to be doing a lot more than we are. We are using this model to finance the development of wetlands off the coastline of Louisiana to slow down the degradation of the coastline there. They're losing about a football field every day. And what's interesting about that work is there's a lot of oil refineries and there's a lot of corporate interests on the coastline there. And it turns out they're less inclined to be open to a conversation about paying for the solutions, especially the nature-based solutions like wetlands. They're less enamored with having that conversation about paying on the front end. But because they've amortized a lot of these plants that have an expected life value, they're very eager and willing to have a conversation about serving as a back-end outcome payer if someone else pays for the development of the wetlands that slows down the degradation of the coastline. Basically, if it works, they're willing to pay. Less excited about paying up front. And that simple notion is something that we're eager to find partners in other areas of the world to see how applicable that thinking is in other places other than Louisiana.
All right, so
Okay.
for the last question, I'm going to read out everything that's up there still, Eric, and then you can choose what you answer and what you don't answer. So from Joss Hill, we have you worked on projects leveraging human health benefits and associated economic benefits of improved health for financing water quality pollution improvement? From Shwana Humphreys, we have, do all cities have the space for sufficient green infrastructure? And my personal favorite from Jason Sohajian, okay, I'm really curious about the music thing now. Tell us about your band and the world of rock music. So take those as you will, Eric.
Sounds good. I'm going to take the human health. And by the way, the music person, feel free to reach out. I did spend 2.5 years living in a tour bus as a drummer in a rock and roll band. So I'm happy to have that conversation. But on the human health side, we have a health team. We have a full health team. We operate in urban coastal resilience, forestry and land use, agriculture, and we have a health and human services practice. The health and human service practice is quite interesting. And we see we see the integration, probably like everybody on this call, we see the high integration between health outcomes and environmental outcomes. The realities are those are very different worlds as money flows. But all the things that we're doing in our environmental practice, like forestry and coastal resilience and urban resilience and agriculture, we know they have health benefits. Some of the evidence that that undergirds the true correlation, meaning if you implement this green infrastructure in this area of this city, will it reduce the number of pediatric asthmatic emergency room visits to that particular hospital? We all know that it does. Is the evidence there? Is it financeable at this day in the year 2020 while we sit here? Not quite. As a secondary benefit bought by a Medicaid MCO? Possibly. So we layer on health and on a lot of our different work because we believe that over time we will bend these railroad tracks that are currently parallel towards each other so that we can bring more beneficiaries like the medical, like healthcare systems to the table to be back-end payers for some of these environmental solutions that we all want to see more of.
Great. And do all cities have space for sufficient green infrastructure? I think it really, really varies. But I think we've seen a lot of cities interested in green infrastructure. They have the space, or they can try and influence private actors who do have the space to do that. In DC, there's actually been essentially a green infrastructure trading system in place as well, where basically if you're going to develop land, the DC entity, DC Environmental Protection Agency, basically says you have to ensure a certain amount of permeability or green infrastructure on your land, and if you can't, you have to pay somebody else to do that for you. So it's kind of like carbon offsets, but for green infrastructure. So we're seeing a lot of innovation and improvement in that space, partly because of something Eric mentioned earlier, which is this consent decrees and the fact that the federal government is putting pressure on many cities to deal with that side. It's important to mention that some of that is driven by legislation like the Clean Water Act. So government and legislation plays a role. And currently, at least in the US, the government is being a little different about how it enforces environmental legislations than say previous administrations. So we'll see how that happens. Well, we've reached the end of our 90 minutes. I want to thank Eric so much for sharing the innovation. He's always been extremely candid, you know, opening the kimono and showing everything that they're doing and how they're doing it. Really appreciate it, Eric, and thanks so much for being so innovative in the way you're addressing conservation finance. Truly some of the most interesting, innovative stuff out there, and we wish you the best of luck in continuing that. And hopefully, we can get a lot more of this going all over the world. And hopefully you guys have taken something from all of this. Really appreciate it. I'm always around for follow-up. I think you guys can all reach me. And I can forward it to Eric, or Eric can share his contact details, whatever. Appreciate it. And we'll also point you towards some of the websites. Quantified Ventures website has a lot of information about a lot of this. So again, thanks to Kinship, thanks to Shelby, thanks to Ceci for helping set this up, and Eric, thank you so much, man.
Yeah, thank you, my man. You wrote the book on all this stuff, and we're all just trying to keep up, my friend. What a treat. And for everybody on the phone, let's call this the beginning of a long conversation. We by no means have everything figured out. Matter of fact, we don't have a whole lot figured out. This is fun stuff. It's interesting. It's certainly where the dollars are going. So let's figure it out together.
Awesome. Thanks so much.
Thanks, everybody.